Is this working? It is. Look at that. Okay. Lindsay, how are you doing?
Doing great. How are you doing, Joe?
I am very good. So we're going live. We haven't done this in a long time, so bear with us. We had some technical difficulties getting on here. But here's where we're at. The Fed rate decision is imminent, which means it's going to come at any moment now.
Any moment.
And the predictions are all over the place. Let me show you a couple things. This is probably going to, let me see here. Let's see. We'll go here. This is going to make you ill for a quick second, then we'll get to it. There you go. So look, the Fed rate decision, this is CME Group's Fed Rate Watch. It's a 57% chance of a 50 basis point drop by the Fed, 43% chance of a 25 basis point drop. So this is what we're looking at. And it's been baked into the market the last couple of days that a 50 basis point drop by the Fed is going to happen.
Yes. So this is going to be like a three-part thing, right? We're going to kind of wait around for the statement. They're going to tell us their decision and then hopefully give our reaction and our expert opinion on what happens
right,
today.
And the aftermath. And then at 2:30, I believe,
the aftermath.
Jerome Powell speaks. The breaking news is coming any second now. It is kind of exciting, but why is it exciting is because this is the first rate drop. If the rate drop happens, which we just got word, this literally just came in, that the Fed is 50 basis point hit. Okay, so they're dropping the rates by 50 basis points. This was baked into the markets. We're going to see the markets respond. Let's go over here. The MBS Live, great software for live real-time data. I'm probably not supposed to be broadcasting this, so I'll probably pull that off. But basically, the Fed, the markets are going to react real soon to this information. I mean, we just got this. This is Bloomberg. We're showing their YouTube channel. We were worried it was going to be 25 basis points.
Yeah.
Now, the Fed is signaling that the economy might not be as rosy as everyone thinks it is, but this Fed rate decision means that this is kind of what was baked in. So we should see rates not drop significantly today. But this might mean some broader things for the economy. But for housing, this is actually potentially a positive thing.
I think it's a great thing for the housing market. I think a lot of people were kind of debating whether or not it was going to be the 25 or 50, and some experts were saying 50 might be too aggressive. What are your thoughts on that?
50, it's, again, the market was a 70% chance of a 50 a couple days ago.
Yeah.
And as they got closer, there's some other data that came out, and they were going 25. Well, if we had a 25 basis, I think the market had baked in 50.
Yeah.
So now they might have gotten backed into a corner. I don't know that the Fed really reacts that way. The Fed's job is they have a couple jobs, but one of the jobs is to kind of fight off inflation. And the other piece of their job is to make sure that we use the monetary policy, the policy about, with interest rates in order to not lead the economy into a recession.
Right.
So by dropping or softening the rates, it makes money a little less expensive.
Right.
And if money's a little less expensive right now, think about it. We have the highest all-time credit credit card debt that we've had. And I'm looking at, I'm looking at other markets here, and I'm seeing the broader markets react right now. I'm not going to show you these screens, but, I think the stock market likes it. The yield on the 2-year is going down. The yield on the 10-year is, they moved the screen. But, it's going to go to a weaker dollar and things like that. But the job is to help stave off inflation.
So what do you think this means for affordability and demand for our market?
Well, how many people have you talked to in the last year or two that said, I'm going to wait for rates to go down?
Oh, gosh. I sat at an open house where a family came through, and that gentleman, when I asked him how long he had been waiting, because he said he's going to sit back and wait for rates to come down, his answer was 2019. It was how long he's been waiting. So there's plenty of people that have been sitting on the fence waiting for something to happen.
Yeah, and so that's what's going on. Haley, are we streaming live? Are we still live? Okay, good. I just had to double check. So look, here's the deal: is that as rates are coming down, and look, 50 basis points is just the beginning. All right. Now, if I go back to that tool that I used, the CME Fed Rate Watch tool, if I look at the next couple meetings, there are more rate cuts coming. So then it begs the question. I bet a lot of people are thinking, well, I'll just wait till those rate cuts come, right?
Yeah.
But if they make this rate cut and they see a really quick turnaround of certain things, they might want to slow down inflation.
Right.
So the future isn't guaranteed.
Well, and with it being such a big rate cut initially, what do you think that means for predictions for the future ones from now until the end of the year?
Well, I'm looking at this right now. They're predicting another Let's see. That's 25. Another 50 come November, December. Another 25. So, by the end of the year, that could mean 100, 125 basis point drop. Now, what does that mean?
I was just going to say, for those watching that don't understand what the basis point means, how does that translate into interest rates?
That's a great question because it's not dollar for dollar, point for point.
Right.
A basis point, look at it this way, 100 basis points is 1%. And this is the rate at which the Federal Reserve lets banks borrow money from them. Okay, it's they call it the overnight rate. It's the rate at which banks borrow money, basically. And then so if you think about it, things like credit cards, some degree student loans, auto loans, home equity lines of credit, they're all based on what's called a prime rate, right? So they take the federal funds rate plus some kind of margin to come up with a prime rate, and then they add stuff on that top of that, sometimes give or take, it's +1 or -1, to really come up with a rate that majority of consumer credit debt uses. Now, mortgages aren't necessarily directly impacted by the federal funds rate.
So then how does it trickle into mortgages if it's affecting, auto and all of those other things that you said?
Well, it doesn't necessarily, like you said, trickle in. What happens is that the same factors that are looking at how to decide this federal funds rate, they're the same people buying mortgage-backed securities or the bonds, and not to get too technical, but the more people that buy a bond, it drives the price up, but the yield or the interest rate down.
Gotcha.
Okay, so it's the relationship is that if more people are buying something, the price goes up. But I could explain exactly how this happens, but in the spirit of time and my own brain cells right now, I'm just going to go with that it drives the interest rate down.
Right.
Okay, so right now the interest rates are being driven down. By people buying bonds because they're going to run out. They're going to say, look, let's, if they're still offering a 5.5% coupon bond or a bond, I'm going to buy that bond now because rates are going to be 5% or 4% on those bonds in the future, and I'm going to be locked into a 5.5%.
Right.
So they're going to go buy those, and it's going to drive the price up and the interest rates down. And that's what we're going to see is there's going to be, there might be a flight to quality to bonds. People are going to run to buy bonds because they want that higher rate of return. Now, here's the negative piece is that your interest rates on your savings accounts are going to be affected. Those are going to go down, right? They don't need your money as bad, right?
Right.
I shouldn't say that. They still need and want your money. Make sure you give it to them. I'm kidding. But
Good advice.
But look, the interest rates on your savings accounts are going to go down. And if they go down to where they were in the past, which is 0, you're going to want to go out and find a return for your money, aren't you?
Yeah, certainly.
So where are you going to go?
Housing market.
You might go to housing, you might go to stocks, you might go to crypto, you might go to bond, but the point is that there's going to be an appetite for return. An appetite for return, like interest rates, a higher rate of return on your money.
Sure.
And a flight to quality might mean they're leaving this for that. And if they're buying bonds, then interest rates are going to come down.
Sure.
And that's what we're going to see is that flight to return or quality is kind of the main thing.
So with that flight to quality that you're mentioning, would you advise people, obviously we're in the business of real estate, right? So would you advise borrowers to be locking in their interest rates now? Is that something that you would put out there?
Well, look, you got to look at a home as a place to live. I mean, you got to look at, do I need a place to live? Yes. Then you buy a home, right? Typically, you might rent or you might buy. You're going to make the decision, do I want to rent or do I want to buy? And if you make the decision to buy, well, the longer you wait, as we see historically speaking, prices have gone up.
Sure.
And I remember in 2008 when prices went down. And that that great recession that I lived through in the mortgage industry was caused by housing and the availability of credit. And we had an overabundance of availability of credit. They had loans such as no income, no asset, no job, yes, loan.
That's terrifying.
That's terrifying.
Recipe for disaster.
They had no, what we called in the industry, and we didn't do them here, the liar loans. Like, just tell me how much you made, right?
Yeah.
And things like that, so that caused a recession. Housing went down significantly. But if you look at all the recessions over time, very rarely did housing go down. Because what happens when a recession comes, rates go down, it incentivizes people to buy housing, prices go up. When you buy more things, buy more of the same thing, prices tend to rise. Until there's more people selling than buying, then prices go down. Now, if you look at purely the demographics in our country right now, we're a growing country. I think since the last census in 2010 to 2020, we grew like 10% as a nation.
It's incredible.
So there's more people here. I'm not getting into documented or otherwise because it's irrelevant. There's still a greater need for housing. And in between 2008, when the housing crisis happened, if you look at 2008, a lot of builders stopped building because there was no market for it. There's no funding for it.
Right.
There's no bank saying, yeah, I'll give you money to build houses, because people were giving away houses, not trying to bring them in,
Yeah.
right?
And they weren't about to float that money for another decade until things shifted.
Yes.
Yeah.
So 2008 to 2014, not a lot of building happened.
Right.
And then 2012, 13, 14, people started to come back to build houses, but we still have a 5 to 10 million housing shortage in this country.
Wow.
If you look on the MLSs around the country, their listings are certainly up from a year or two ago, but they're at more of a normal level of supply, not an abundance or not a deficiency, but a normal level of supply. So what does that mean? It means that the supply really hasn't increased significantly, but there's more and more people in this country that want or need to buy houses.
Right.
So in supply and demand are out of whack, prices going to, in the favor of higher prices, the prices will rise until there's an equilibrium met. They might stabilize and then they might go down, but I don't know when that would happen.
Right. Well, kind of shifting gears a little bit with
Thank you.
this
I get
news
off
of the 50 basis points, I also still wanted to keep it within the real estate realm of things. People that have purchased within the last couple of years, what does this mean for people that were maybe not happy with their interest rate? When it comes to refinance, what does this information mean for them?
The people that haven't refinanced, well, first of all, again, you want to look at, if you have a loan right now, is it time to refinance? Well, what's your rate? But we just did a podcast on this. I don't know if that went out last week, but there's lots of reasons to refinance. Better cash flow, pay your loan off quicker, pay less interest on your loan, all these things. There's also reasons not to refinance, but there's a lot of people sitting with lots of equity in their homes right now. I mean, there's a record amount of equity in homes.
Right.
There's a record amount of credit card debt. I see a potential solution there. Now, I don't like to tell people to use your house like a piggy bank, but if it puts you in a better financial situation and you use those extra funds to maybe pay down that mortgage faster, because you will have an increased cash flow potentially, then that makes sense, and it takes certain guidance. But let's go back to even the housing market. If you just go back to the housing market, what is lower interest rates going to do to the housing market?
I think when it comes to lower interest rates, it's going to cause people, one, that have been sitting on the fence to rush in. It's going to cause first-time home buyers that were maybe thinking it wasn't within the realm of possibility for them. All of a sudden, affordability is within reach, and that's attainable. So there's a whole demographic that's going to be coming into the market as well. I think it's great things, for anybody that's wanting to get into purchasing right now.
I just got some more breaking news. So the Fed, in their announcements today, they also talked about their target rates over the next, through the end of this year and through next year. And so this year they're targeting, this is, let me see the Fed rate watch. This is really interesting, and I would urge you to stay on here. Haley, do we get the new link out to social media and things like that? Okay, could you even put it to Facebook and Instagram? Sweet. All right, so look, the Federal Reserve, I'm looking at some the Fed Rate Watch tool that we look at, and it's a pretty good tool. But this is predicted by the end of December. There's a good chance where it'd be about 4 to 4.25. This is the tool that I look at. Well, the Fed said in their report that they predicted to be around 4.4 by the end of the year. So that's in line with what we're seeing here. But that is about 100 basis points less than it was prior to this cut. So they're looking at 1, maybe 2 more cuts for this year. And if the data keeps coming out in a certain way, they're going to probably make those 2 cuts. The end of next year, 3.4%. Now, that's not an interest rate on a home. That's the federal funds rate, the rate at which banks borrow money from the Fed. And there's lots of reasons they would do that, and most banks, I think, take advantage of that. I don't know all, I'm not going to speak for all banks, but most banks take advantage of that on the overnight rate. Now, the interesting piece on this is that interest rates are going to follow suit, right?
Right.
So your question earlier that I kind of went around, not purposefully, but just because I'm like a squirrel.
Which one was that?
Exactly. But you asked the question, should I wait to buy a house?
Right.
And I said, well, there's a lot of factors you got to look at, but the answer is no, because prices are going to go up. Prices are going to go up. Now, I can't guarantee you that. This is not financial advice. Do your own research and make sure you consult. But my opinion is that prices are going to continue to rise because of that equilibrium not being met. We've talked to countless buyers. There's probably a count to them, so not entirely countless, but we've talked to a lot of people, hundreds, that we've come in contact with that say these words: I'm going to wait till the rates come down. And what I can tell you is when rates come down, people come back to the market, and the more people that come into this market, the more the prices are going to go up.
So I think moral of that story is whenever you can get into the game, get into the game.
You're right. And looking at the mortgage-backed security market, I think we're going to see a very quick, short dip in those markets. Why? Well, people react. They buy the what's the saying? It's like you buy the rumor, you sell the news, and so there's people taking profits off the table. But looking at the mortgage-backed securities, the majority of the markets kind of flattened almost. Kind of come back to neutral, and you're going to see it bounce around the rest of the year. The interest rates. There's going to be pockets of better rates, and then there's going to be pockets of worse rates. But it's going to go like this through the end of the year, and but the overall trend is going to be improving interest rates. But that might mean there's some days that are better than others.
Right.
So if you're looking to refinance and you like what you see, you might want to act in on that lower rate. I mean, if you don't like it, wait for the rate you want. But if your expectations are 2 or 3%, your expectations are going to be wildly mismanaged. And I just don't think it's going to go that low unless we have some kind of tremendously terrible event, which none of us really want, another pandemic, right? Do you want another pandemic?
No, definitely not. I'll take higher interest rates over a pandemic any day.
Yeah. So short of some kind of natural disaster, which God forbid, anything like that happens, I don't see an event that's going to push us down, short-term, realistic event that's going to push our interest rates down like it was in 20 and 21, hopefully.
Right.
I mean,
Hopefully.
God, that would be terrible.
Yeah. You had referenced something a couple podcasts back about a soft landing. What exactly does a soft landing mean, and is that what's actually happening here?
All right. So a soft landing refers to the economy not going into recession. Or a hard landing would be, boom, we came off these high interest rates. We stayed too high for too long, and it sent the interest rates into a
tizzy, tizzy, if you will,
the economy into a tizzy,
right.
and it really had an effect on the broader economy. Well, you can't deny that higher interest rates for a long time had an effect. But remember, inflation's a scary thing. Inflation's a scary thing because that means your dollars. If you think about people on fixed incomes, their dollars are worth less than they were 3-4 years ago.
Right.
I mean, you go to the grocery store, you can literally buy less today with $1. I don't know if $1 even buys you anything. I'm old enough to be able to say I remember when a candy bar was a nickel. No, it wasn't a nickel, it was a quarter. Maybe 50 cents, 2 quarters.
You are old, Joe.
I know, but I remember putting a quarter into a video game machine.
Yeah.
Video game machine. These are they stand up. You put money into them and you play
Soda
a game.
machines. You
Soda
got those
machines,
ones too.
right?
Those were 25 cents.
Now they're like
sodas.
$3. I'm
Yeah.
like, I don't even have dollars. How do I even? Now they'll take your credit card.
Yeah.
But the point is, that's inflation. Is your money goes less far than it did before, and that's a very dangerous thing because money in the bank is worth less now than it was 2 years ago. Fact, right? Grocery stores cost more of that money now than it did 2-3 years ago. 3 years ago, right?
Yeah.
More. Everything in the grocery store costs more. Your gas costs more. Your groceries cost more. Anything you buy costs more. If you want to have someone come to your house and fix something, it's going to cost more. That's inflation. It's dangerous.
Yeah.
So most of this is to stave off inflation.
Good. Another quick question for you. Obviously, these are big changes that we haven't seen in quite some time. How quickly do these changes in the federal funds rate typically influence the mortgage market? Is this something that we're going to see an immediate impact from, or is it going to take a little while for us to feel the effects of it?
Well, it's interesting because we've seen rates improve since July. I mean, I look at the mortgage-backed security market, which dictates rates on the street, and I've seen rates get better since really May, actually. There's been trends of we're better and worsening rates since May.
Right.
The trend's been better rates. I go like this because it's the price of the bond, but the rates have come down like this. There's pockets of better rates, but they come down like this. Now, they're going to be very volatile. They're going to bounce around based on the data and the news. I can see the rates right now are getting a little bit worse as we speak. Again, they baked in 50 basis points. We got 50 basis points. People are taking their trades because this is price action. It's all based on the trading of a mortgage-backed security market.
Right.
People think that we set the interest rates. We do to some degree, a very minuscule degree, we set the rates. But the broader thing is, like, how much is Fannie Mae or Freddie Mac going to pay me for that loan when we sell it or securitize it? If you're a bank, you're selling to Fannie Mae, Freddie Mac, or securitizing with a VA, FHA, or USDA loan with Ginnie Mae. And it's how much am I going to get in return for this work I've done?
Right.
I found a borrower. I've underwritten it to the standard. I've closed that loan all within the guidelines, and I have a signed note that I'm selling this note to Fannie Mae or Freddie Mac. How much are they going to give me for that? Right? If it's at 5%, they're going to give me something different than it's at 6%. Obviously, there's a lot more to it.
Right.
But the bottom line is banks and lenders don't necessarily set the broader rates, and we're kind of subject to the market.
And then on top of that, it's just the cost of doing business with that particular bank or broker.
There's lots of different factors in marketing and things like that.
Yeah.
But lenders, their rates don't vary by several points.
Right.
They're kind of within a spread.
Right.
And it depends on how it's marketed, how many points it has, how it's sold, how long it takes them, lots of different factors.
So at that point, it's just a function of math.
It's always a function of math. It's always a function of math.
Right.
So I'm looking at the initial reaction of the market. It looks like the risk employment inflation goes in balance. Look, the Fed's trying to get rid of the notion of going into a big old recession. That's the fear. Nobody wants that. But I'm looking at the interest rates, right, like the mortgage-backed security market. It's pretty flat because we kind of hit within expectations. Before this meeting, there was a sell-off of the bonds, which means the rates were going up a little bit. Now, then we saw it go the other direction because we got what we want. I should say the market got what it asked for,
Right.
or baked in or bet on. And now it's kind of come, back to equilibrium where it's starting to balance out, and over time it's going to go back to what's the next event. We waited for this event for a while. The rates have kind of come down since everyone thought 50 basis points,
Right.
and here we are.
Yeah. Are there any type of loans, specifically like a fixed rate versus an adjustable, that are more impacted by today's decision, or are they all impacted equally?
If you have a fixed rate mortgage right now on your house, your rate is not changing, right? It's a fixed rate.
Right.
If you have an adjustable rate mortgage, it might go down. It might go down, right? It might not, depending on how it adjusts and things like that. Maybe doesn't adjust till the 5th year or the 3rd year, and maybe it's every 6 months, but not today. So it just depends on how that loan was written. But that's a good question. What other types of questions do you have?
Well, the biggest ones are how it's going to impact the market in the short term. I think we know long term, what they're predicting from now until the end of the year, but short term, is there any difference between, seasoned investors and first-time home buyers? Does it impact one more than the other?
So let me answer that question, but let's just go back. The breaking news right now is the Fed dropped their rates by 50 basis points. So if you're just joining us, that's the news today. That's the news right now, is that the Fed has dropped the rate 50 basis points. It hasn't had a widespread effect on mortgage rates right this second, but it's been baked in the last couple days, weeks. The rates have trickled down a little bit,
Right.
Okay, in anticipation for this. Had the rates gone up to 25, only gone down 25 basis points, we would have seen the market react to that, not getting what they expected. Rates would have gone up today. If it had gone down by 75 basis points, the market would have reacted and the rates would have gone down just a little bit. But because we got as expected, it's been what we call baked in, that the market really hasn't reacted negatively or positively. It's right there. It's pretty flat. Within 8-9 basis points, not a big move on the market. So it came in as expected. So to answer your question, going back a step, I know we had some people just join us. Thanks for joining in. Lindsay and I from the vault. Here's the vault door. This is an actual vault at our office that,
So official.
that's been here since this was built in 1964, 5, 6, 7-ish, somewhere around there. It was a Federal Reserve Bank vault. For those of you looking to see if there's money in this vault, there's not. So if you're thinking about, hey, this might be an opportunity to get some free cash, not the case.
Just chairs and tables and
Yeah,
meetings.
but this is an actual bank vault door that weighs a ton, probably 2. I don't know. It was so much that wasn't worth removing from the office. I love this thing. I think it's the coolest piece.
I usually like to invite people to come see if they can move it.
Yeah, you can probably. It's on a swivel, so you might be able to get it closed. Closing it, locking it. There's an air vent in there, so don't worry if you get locked in. Your cell probably won't work, but we'll figure out you're in there after a little bit.
You've got air, it's fine.
You've got air, it's fine. Let's go back. You're going to have to remind me of your question because I'm a squirrel.
My question was whether or not it's going to impact investors or
Right.
first-time home buyers, if it impacts one more than the other, or if it's just all across the board.
It is, well, when you say impact, yes, the rates are going to change for everybody. Okay, rates, let's start what the Fed rate does directly impact. It directly impacts prime rate, credit cards, most auto loans, most home equity lines of credit, most that aren't fixed. Most student loans, I think, may have an effect on. It has an indirect effect on mortgage rates. The same people that would buy these bonds that, the same people that are looking at this as what's inflation doing, they're going to look at the same information and say, well, that's going to affect mortgages this way. And they're going to act accordingly, which will drive ultimately mortgage rates down.
Right.
Right now, a lot of that driving down has already happened. It's been baked into the market. Rates are pretty good right now. Rates are not bad right now. We're better than we were by leaps and bounds than about a year ago. And if I look at the mortgage-backed security market, rates have been improving since May. May we hit kind of the trough. I believe so. Nope, I stand corrected. We hit a trough kind of in October, November of 23. It's kind of, we hit the highest point in rates. I say down because the cost of the bond was down, which means a higher rate. So the bond was at its lowest cost. The rates were at their highest in October, November. And you remember, we had almost like a real estate recession.
We did.
Fourth quarter
Felt
of 2023.
that way anyway. It felt that way.
It was rough. Builders weren't selling homes. Now they are. Rates were in the 7s and 8s
And
even.
credit card debt just continued to rise.
Credit card debt continued to rise. So to answer your question, it affects the rates equally across the board. But an investor, are you going to invest if your cost of money is high? So impact is relative, right? If you need a place to live, well, it's not an investment, it's a place to live.
Correct.
You're going to live there. You're not paying rent. People look at this. This is insane to me. I've seen things there's big, I'm not going to say names, but big hedge funds that don't want you to own anything, right? And I could be wrong on that. It's my opinion. But they want you to rent. So there's a lot of data out there that can try to convince people to rent. But when I pay my mortgage payment every month, part of it goes to interest. That's true. But a part of it goes to principal, right? And I own something that where I put money into and improve it and it appreciates, I'll enjoy that benefit. When you rent, it's 100% of your money goes away.
Gone.
Right. And so your cash flow might be affected accordingly. But as a long-term investment, real estate has always played pretty well.
Yeah.
Played
Someone's mortgage is getting paid. It's just not your own.
Right. And so to answer your question, the first-time home buyer, by all means, it's going to help them pay a little bit less for their house, which means they have a little bit more money to either do things to their house or go out to dinner or to pay their bills down or whatever it may be. But at a higher rate, they don't have that. So there's not that same disposable income out there, which hurts the entire broader economy.
Yeah.
Housing is at the forefront of the broader economy. When housing's down, the economy, is not going to do as well. If there's less housing being built, there's less jobs.
Right.
One of the first indicators people look at when they're looking at is a recession coming is they're going to look at construction jobs because that's at the base level of employment.
Right. So going forward, for those people that just joined us, obviously they were on the fence on whether or not it was a 25 or 50 basis point cut. 50 was what was decided. A lot of the people that were sitting back and waiting, those people are going to enter the market. For the ones that also heard the additional news that there is going to be more rate cuts between now and January, do you think some of those people will still sit on the fence?
I can't predict wholly what's going to happen. I do know this though. If rates are down, the perception is that there's more rates cuts coming. People might wait because they get greedy.
Yeah.
Unfortunately, markets are here. The market, like the stock market, exists because of human emotion. And Americans, not just Americans, people in general, have a tendency to buy high and sell low. And this is instinctual, that goes back thousands of years, okay? The reality is that if you want to buck that system, you buy low and sell high. How do you do that? You buy when others aren't. Right now, if people aren't, get ahead of that trend.
Yeah.
Get ahead of the trend. Rates are good. Are they 3%? No. Are they going to 3%? I don't think so.
Are we ever going to see 2 to 3% again?
I'll never say never, ever again. It could happen. I don't want it to, because what has to happen to get us there is so terrible. I don't care about how much money the business or these businesses make.
Right.
I care about the right thing for the broader economy, the American people. I'm not a politician, but I do, about our customers. And right now, the right thing, if you're watching this thinking, should I refinance? Call us, right? I'm not trying to advertise, but call us, right? If you're thinking, should I buy a house? Can you buy a house? Do you need to buy a house? How much house do you need to buy? Do you already have a house? Are you a first-time home buyer? Because it is a good time to buy. Now, look, right now, the Fed Chair Powell is being his news conference. This is what moves markets right now, and I could display that for you, but I will tell you that this is what moves markets, is what he says, because the words have already the numbers and words have been put out in the statement, but I'll try to show this on the screen. And I'm seeing the market actually go positive on the mortgage-backed security market, which means rates might ever so slightly improve, and that's good. But let's take a look at this. This. Let me see if I can get live on this. All right, so Powell's speaking. Let's just throw this on here.
That with an appropriate recalibration of our policy stance,
Thank you, Bloomberg, by the way.
labor market can be maintained in a context of moderate growth,
I don't know if you can hear that.
sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace.
Somewhat of an equilibrium.
GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first.
I don't want to get in
Improving
trouble with
supply
the,
conditions have supported resilient
the-
demand and the strong
not
performance of the U.S. economy
Not
over
yet.
the past year.
Not yet,
In our summary,
Call us.
but yeah. my radio face. All right, so look, what we're hearing is Fed talk by Powell, and look, here's the deal: is that these words are what move markets. The numbers are out. It's what they predict and how they're going to operate. They're
how-
talking about the data,
And how people are going to emotionally respond to that as well.
right? And how the investors are going to respond, because you got to look at if you look at the stock market right now, what is it doing?
over the past year, and the jobs to workers gap has narrowed.
We're talking about the broader improvement in the economy.
Suggests that conditions in the labor market are now less tight than just before the pandemic.
The labor market's loosening up. That means that we're going to have more unemployment.
Is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years.
Notable ease in inflation, which is why they are dropping down the rates, because their job is to ease inflation.
Right.
Price index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August.
Yeah, a lot of data they're talking about.
For food and energy categories, core PCE prices rose 2.7%.
So, not to bore you with the details of the FAL, but you can probably hear it in the background. And the reality is that they're talking about the improvement in some areas. What they call improvement is not necessarily what we would call improvement. Unemployment was too low. Why is that a problem? Well, if unemployment's too low, you have to increase wages to people to get them to come to work.
Right.
At 0% unemployment, that means that everyone who has a job, or 4%, 3% where we were, everyone who has a job wants a job. And to get someone to come to work for you, you have to pay them more. And then and if you pay them more, well, you have to charge more in order to be able to pay these people, which is called the wage price spiral. And this causes inflation. The cost of oil and energy is one of the other biggest costs of inflation, whether it's directly or indirectly. Every single goods or service, even people going to work, has to depend on the cost of energy. And if the price of energy does not come down, they're going to have a hard time fighting inflation. So how does this affect housing? Let's talk about that. How does this affect housing, Lindsay?
Well, when it comes to the lower interest rates, obviously people that have been sitting on the fence for quite some time are going to be coming back into the market. People that have been waiting. I referenced open house that I had done not too long ago where someone had been waiting since 2019. And then anybody that has purchased within the past couple of years that maybe wanted a better interest rate might be looking to consider refinancing now.
Yeah. So housing, again, lower rates mean more people in the market. More people in the market, more competition for housing.
Right.
Prices potentially going up. Okay. If you're looking to refinance, if you have a 6 or 7% interest rate, it might be time to get refi ready. Talk to a mortgage loan originator. We got plenty of them here to help you out. Give us a ring. It might be time to talk to, take a look and see, hey, is a refinance worth it? And if it's not worth it right now, a good loan originator will tell you that. A bad one will say, yeah, go for it. But it's got to make sense. You got to do the math. It's
the
functional
numbers have
math.
to make sense.
The numbers have to make sense. Make sure someone runs a cost-benefit analysis for you to understand your payback, your costs, the real cost of doing a refinance. And if you're looking to buy a house in the state of Florida, don't do that without talking to us. I mean, gosh, I can't make it any more clear. So with that, I don't know what else is left to say. Powell is acutely aware of high inflation and how it poses a significant hardship to people. The higher interest rates actually cause some of that inflation because it costs more to borrow money. People are borrowing money like crazy right now. It's time to pay off your debt. If you have equity in your house and you have consumer credit debt, I have solutions for you.
There's always a solution.
I have a solution for you. It might be, you might have to get rid of a lower interest rate for a higher one, but what does your total debt picture look like?
I was just going to say, how much do those credit cards actually cost you?
A ton.
Yeah.
A metric ton.
Yeah.
Verifiable ton. That's all I got. Is there anything else going on?
No, I think we talked about the statement that they had before, the decision of the 50 basis points, and then our reaction to it. So unless you guys have any questions for us, please feel free to reach out, type them in the chat.
Put them in the chat. I'll give it a quick minute here. Haley, do we have anything in the chat of anyone who might have any questions for us?
Holly Smith just gave us a shout out as us being her favorite local lenders.
Thank you, Holly.
Aw,
We really
thanks,
appreciate
Holly.
that. Any other things in the chat that we might need to answer, be aware of? Okay. I'll sit here all day. I don't really want to do the rest of the work I got
I
to do
think we
today
have
anyway.
some loans to do and some conversations to have. So while you'd like to sit here all day, I think it's time for us to go.
All right. Well, thank you. Thank you all for watching today. If you have any questions, comments, concerns, like, share, do all the things that kids say to do. Lindsay, any final words?
No, thank you guys so much for tuning in and utilizing us as your resource for up to date information.
Awesome. Thank you all. We'll see you next